Hello everybody, welcome back to another session or another video where we explore a further aspect of asset-backed securities. This time we're going to talk about those asset-backed securities which are distinctly not backed by mortgage loans, and the two that we are going to discuss in terms of providing collateral for these transactions are going to be credit card receivables and something called solar ABS, where the collateral is essentially loans associated with the installment of solar facilities, especially in connection with residential housing. Okay, so let me, just make some very general comments here before I go on to discuss those two types of collateral and associated ABS, asset-backed securities. In essence, the collateral in any ABS transaction, asset-backed security transaction, may be of two types. So it can be either what we call amortizing, that's amortizing collateral, and of course there's also non-amortizing collateral, as the name I guess suggests. So if the collateral is amortizing, and remember the collateral in an ABS are essentially loans, right? The question is, how are those loans being repaid by the underlying borrowers? So if those borrowers are making periodic payments which include both a component, so periodic payments include both an element of interest as well as principal repayments. That's what we call amortizing collateral or amortizing loans, and loans are the collateral in an ABS. Include interest plus principal, or what in many languages is known as capital repayments. But in English we call this officially principal. This is where you are repaying some of the amounts, the actual amount of the loan. Interest is what you pay on top of that. And of course the most obvious one of these, or example of these, is going to be mortgage loans. Mortgage loans are definitely loans where typically on a monthly basis the borrower makes a repayment of principal, a bit of principal, and also interest. And typically at the very beginning you pay not so much principal but a lot of interest, and then as time goes by, the balance changes. Okay, mortgage loans, another example would be something like auto loans, that is loans to buy cars, vehicles. Right. And if you are an investor who buys an ABS that is secured on one of these amortizing pools of collateral, so thinking about this from the perspective of the investor receives, therefore, two things: both scheduled principal repayments. Obviously, they also receive interest payments, but very critically also another element, that is all the effects of potential prepayments plus effect of any prepayments. Those are payments made outside of the official loan repayment schedule, as you may be aware, especially in the United States, but not only limited to the United States. Borrowers, mortgage borrowers may prepay their loan very often because they find a better deal and they decide to refinance an existing loan with a new one on better terms, and that's known as a prepayment. So if you are somebody who is an investor in an ABS, and lots of prepayments happen typically because interest rates drop and people go to refinance at lower rates, you'll feel the effect of that. And what precise effect you'll feel, so the distribution of those prepayments, or of all the cash flows essentially is going to be based on the principles established by the subordination, potential subordination. So based on classes, subordination, of course, if you're investing in a pass-through security, those distributions will more or less be proportional among all the investors, but if you hold a specific class of bonds in an ABS, well, that might be very much different. And of course, with amortizing structures over time, both the number of loans serving as collateral, as well as their total value, principal value, will fall due to the fact that some loans are being repaid or prepaid earlier than others, and generally those that still remain are being repaid, I guess, on a more or less current basis. Okay, so that's amortizing structures. The other one you of course need to know about, and this is what we're going to discuss mainly in this lesson, is non-amortizing types of collateral. And this is, well, I mean, the prime example of this is going to be credit card receivables, especially banks or financial institutions in general, when they allow customers to make purchases using credit cards, that builds up an asset on their balance sheet, a receivable. It's not, it's not the same as a normal bank credit or bank loan, which has scheduled repayments. All of you who use credit cards will know that, but it is a form of asset, a receivable for the card, from the card issuer's point of view. So credit card receivables don't have any scheduled repayments of principal, no scheduled repayments of principal. In general, those of us who repay our cards on a consistent basis do so typically monthly. Those who are lagging behind will pay whenever they can. They need to pay a minimum amount, and they do incur interest on this. But there is no such thing as a schedule, as you would find with a mortgage loan or a loan to buy a car, for example. So there are going to be some very specific features associated with creating an ABS based on non-amortizing loans, such as ABSs, but we'll also talk about solar ABSs, which are based on more sort of fixed schedule loans. Right, so let's get cracking with this. Maybe I will just mention one feature that we'll come back to in a few minutes. What you will find, especially with credit card receivable based ABS, is that the securities being issued will typically feature something known as a lockout period, also known as the revolving period. Okay, two names to sort of commit to memory. And the idea is that during the repayment period, so that came out completely wrong, any repayment of principal by the clients, by the borrowers who use credit cards, repayments of principal are essentially not distributed among ABS investors. The repayments of principal here are used to purchase additional receivables, additional card receivables, so as to not give money back to investors too quickly. And that's absolutely nothing against the investors. We want them to earn more interest, and they will only earn interest if money is not being returned to them too quickly. And the principal is being used to purchase additional card receivables, so essentially it's being reinvested into additional loans, which go into the pool of collateral. And only after the lockout period ends over here will we actually use principal repayments to make distributions among investors? So principal repayments genuinely used to make payments to the end ABS investors, to investors. Okay, good. We'll have a little bit more to say about this in just a few minutes. Good. So let's properly start. With credit card receivables. I don't think I need to, or credit card asset-backed securities. I don't think I really need to go into what a credit card is. Most of us know it. You use it to make payments, and it's to buy stuff, and essentially you need to pay it back on a deferred basis. From a bank's point of view, or a financial institution's point of view, or simply the issuer's point of view, it does. That money outstanding does represent an asset on the balance sheet. It's a credit card receivable, and that credit card receivable can be used as collateral, get pulled together with other receivables of a similar nature, and get used as collateral in an ABS, in an asset-backed security transaction. If you think about it from the point of view of the bank, why would they do this? Well, it's the same reasons as we had before, and I've written them down a couple of times, so I'm not necessarily going to do it again. The benefit is you're going to remove the receivable from your assets, from your balance sheet, and if that's going to happen, you will not need to finance it, kind of thinking from the other perspective, other side of the balance sheet. You will not need to have funding for it. That funding may be used for something else. And very importantly, in the banking sector, it will also not require a capital buffer. If you can get something out of your assets, something that is potentially risky, you no longer need to hold a capital cushion, a capital buffer to absorb potential losses that may come from it. So that's very important. And servicing cards still generates a lot of fee income, which the bank earns, whilst having less capital and funding engaged. So this may increase our overall return on equity, our overall return on capital employed. Okay, so as I said before, the cards are very often associated with a lockup period. So what we said over here, that's very typical for card ABSs. And let's just make sure that you appreciate this. You may get a theoretical question on it. No numerical questions in this study session, so to speak. Credit cards, as such, generate, so let's just make sure this is credit cards, not ABSs, but credit cards generate 3 types of cash flows. And this is something you may get asked about, so I want to make this very clear and very explicit. First of all, something that your curriculum refers to as finance charges. Now, when they say finance charges, what they simply mean is the periodic, typically monthly, interest charge, right? Interest that is charged on any unpaid balance of the credit card. On unpaid, unsettled credit card balances. So you'll probably have experience of this. If you've used your credit card to make payments, to make purchases, you will have a date by which the balance should be settled, and if you do not manage to pay your card off within that time, interest will accrue, and it's typically not a small amount. Well, okay, that's finance charges. The second cash flow type, so to speak, is fees. And cards do generate fee cash flows as well. Those will be to do with annual sort of membership fees, plus late payment. If you're late on your card, if you're late on paying the minimum so-called payment, making the minimum payment, you'll get a pretty sizable, typically late payment fee. Okay, and the third type of cash flow is, of course, principal repayments. That's when people actually pay off the balance, either fully or partially. So principal repayments. Okay. Now, taking this back to, actually before I take it back to the idea of lockup periods, because this is what I wanted to do, let me just say, or let me just state something that your curriculum is quite keen to emphasize, that the interest here that is charged onto the credit card customer may either be of a fixed nature or of a floating nature. That's the interest rate, may be either fixed or floating. But if floating, the important thing to appreciate that is that if floating, then the actual interest is typically capped. There's going to be an upper limit, a sort of ceiling on how much a customer can be charged. Right, well, whether you've had experience of that such a structure or not doesn't really matter. Your book says, watch out, the interest may be capped, which I guess impacts the investor in an ABS, because they will be receiving something that is that is impacted by very much a consequence of what the customer at the top is paying. Right, so let's take this just for a minute back to the idea of having a lockup period. So if this is time over here, and let's say this is the lockup period, which I mentioned before. Obviously, this is the moment where the ABS is being issued, so that's kind of our point zero. Lockup period slash revolving period. Remember, that was an alternative name for this. What does the investor actually receive? Well, the investor in the ABS that is secured by credit card receivables, investor receives just finance charges, that's interest. Sorry, let me write that again. Finance charges, interest, plus fees. They don't get any principal being repaid to them or paid to them. Why? Because all the principal which the customers, the borrowers, pay is being used to purchase additional receivables, that it's being reinvested. So principal repayments are reinvested. That's the whole idea. Okay, it's only once that lockup period is over, okay, then that we move on to a structure where the investor receives pretty much everything, right? Investor receives finance charges, and obviously they don't receive at 100%. There is a fee that is being deducted by the institution servicing the whole thing. So finance charges, fees, and also the principal repayments. So please do appreciate this. Your book does really go on about this. They make a big point of it. So if this will get tested, this little bit of the curriculum, I'm sure this will come up in one way or another in the in a question, if such a question is indeed asked. And look, because the principal repayments are happening now, the collateral value is actually going to finally start to drop, because beforehand any principal that was being repaid was being reinvested, so you can imagine that the collateral value was being kept stable, whereas here it's going to change. And also one more thing, as those repayments happen, don't think that it typically goes proportionately in a sort of in an egalitarian way to all the investors, because you will typically find subordination in these structures. So over here, let me just say that credit card ABSs, asset-backed securities, are very sort of commonly associated with subordination, commonly split into classes. So tranche A investors receive the principal repayments first, then tranche B, etc. You know what that means. Classes. So that's the idea of subordination. Good. Right, let me just say one more thing on this, and then we'll change to solar ABSs. Another feature that's quite common for credit card related ABS structures is something called rapid amortization, and this will be written into the to the whole scheme as a rapid amortization provision. So rapid amortization provisions, that's the official name. So what's this? This is an early repayment in case of a specific event, in case of specific events. And the rapid amortization provision or provisions are also known as, aka, early amortization, provisions, although that is sort of quite logical, isn't it? I'm sure you would have no problem associating the two. Right, what is this all about? It provides a safeguard. It provides a bit of a buffer. It's a safeguard. It safeguards the credit quality of the ABS issue. Okay, and this is especially true during the initial revolving period. So over here, the lockup or revolving period. So how does it actually work? If it turns out that the repayments during that revolving period are actually insufficient to recreate the pool, to replenish is the right word, replenish the collateral pool, that you typically associate this basically with defaults being too high, right? The collateral value dropping, but not as a result necessarily of receiving money back, which you could, I guess, reinvest into fresh assets, fresh receivables, but it's not. People are simply defaulting on their credit card receivables, so they're not repaying, but money is not flowing either. So defaults are just too high. Okay. Well, that will trigger the rapid amortization provision. Rapid amortization is triggered. And investors receive their money back earlier. Money back earlier. So there's none of that, let's reinvest it into fresh loan receivables. No, you just start getting your money back much quicker, so that you can potentially, as an investor, rethink what you want to invest the money into. I guess something of a higher quality potentially, if that's what you want. But yeah, that's going to upset the original idea of having a revolving period during which principal repayments are not happening from the investor's point of view. So that's something absolutely to bear in mind. Do appreciate what a rapid amortization provision means. You get your money back earlier, despite not necessarily yet being in the beyond the lockup or revolving period. Okay, let's now move on to the second type of non-mortgage ABS. That's going to be a solar ABS, and this one has nothing to do with non-amortizing collateral. When we talk about solar, when your curriculum talks about solar asset-backed securities, the collateral is going to be in the form of loans or various types of loan or receivables associated with home improvements, where generally, especially residential homes, are being fitted out with solar panel installation to make them more energy efficient, more eco-friendly, etc., etc. So that's the association you should have. And very often, because the expense associated with fitting solar panels onto a house, not just the panels but the whole everything that has to go inside as well, is quite substantial. Clients take out loans to do so, or they potentially, they may also lease the associated equipment from a company. So the collateral on these things could be of two types. It may be solar loans. So this is quite self-explanatory, isn't it? It's loans, to purchase the solar systems, the relevant equipment. The other type, so let's do an or, solar leases, which would be agreements to rent those same solar systems. Okay, either one can do. In both cases, the company granting either the loan or the lease has some kind of receivable on its balance sheet, a loan receivable or a lease receivable. In either case, it's an asset, right? So if a securitization does indeed happen, just like with the bank before, you will remove the receivable from your balance sheet. You will not need as much funding as before because you're no longer holding that asset. That increases your typically your return on equity. That generates fee income, and you are more capital efficient. And I guess you look like a better company. Whether you really are is a different thing, right? That's often not to do with the financing side, but the operating side of the business. Okay. The proceeds from such a structuring, proceeds from a solar ABS are often invested into or directed to green projects, what we call green projects, environmentally friendly projects. And in general, these solar ABSs may absolutely qualify, or investing into these bonds may qualify as green bonds or green bond investing. And as a result, this is pretty much sought after by those investors who want to show that they're doing things in an environmentally responsible way. They comply with certain ESG principles. Funds seek these out because their clients, the investors, want to make sure that their money is being invested in accordance with certain green principles. So let me just give you a little bit more. Solar ABSs Of course, they are collateralized by the underlying receivables over here, right? Or loan receivables, lease receivables. They may also be collateralized by actual mortgage loans on properties. So that's actually quite pretty good collateral, especially when you consider the fact that the borrowers, the people who install such systems onto their houses, are typically considered to be prime borrowers. Typically, prime borrowers. This is not something you take on, unless you actually are typically, in a pretty good financial situation. So they're good quality prime borrowers. They own their homes. They are home owners, which is why the home itself may also be used as collateral or a mortgage loan, right? And they typically have a good payment history. Once again, that is to do with their overall financial situation. So, you get a pretty good type of collateral with a pretty good individual behind the loan, the borrower. And you also get additional protection, and that is something we've seen already, protection in the other types of ABSs, the mortgage associated ones. So you will have over collateralization. That's the classic, right? The value of the collateral exceeding the value of the loans. You get subordination, you get tranching, so investors can absolutely pick and choose which specific tranche or which specific bond class they want to go for. And you also have excess spreads. Remember, that's the idea where you create a bit of a buffer because what the borrower is paying as interest is higher than what the investors are receiving as interest. Hence, a bit of a buffer to potentially accommodate shortfall that may happen. And right, let's also say that there is another sort of important feature here, and that is a pre-funding period. What that means, it's a period during which the trust, remember the trust is always the entity that buys the receivables from the issuer, from the whoever had them on their balance sheet before, can acquire. So think of the trust as the sort of the special purpose entity, right? Acquire additional qualifying transactions into the pool. As they may not all be there at one time. Right, so that's just another little feature. That's it for this section on non-mortgage associated ABSs. We had an example of a non-amortizing type of collateral in the form of credit card receivables, and then definitely amortizing solar ABSs or solar loans. However, you're likely to get technically examined very much more on the credit card receivables, definitely more there to test.